Isn't it kind of wild when you think about it? We spend, what, 12 plus years in school learning history, science, math, but almost nothing about money, how it works.
It really is. It leaves this huge gap. Most of us end up just figuring it out based on what we heard growing up at home.
Which, as we're going to get into, isn't always the best recipe for, actually building wealth.
Exactly. You can be brilliant in your job, a doctor, a lawyer, whatever, but still feel completely lost when it comes to your own finances.
Yeah. So that's what brings us here today. We know you're looking for a solid understanding of this stuff quickly without getting buried in jargon. So we're diving deep into Robert Kiyosaki's Rich Dad, Poor Dad.
Right. USA Today called it a starting point for anyone looking to gain control of their financial future. That feels about right.
It really does. And the book's popularity, I think, comes down to that core question it asks, doesn't it?
Definitely. What are the rich teaching their kids about money that the poor middle class often aren't? It's about those sort of unwritten rules.
Uh-huh. So our goal here isn't just to summarize the book. We want to pull out those key insights, those aha moments that can genuinely change how you think about money.
And keep it practical, keep it accessible, like a shortcut to some really big ideas.
Exactly. And Kiyosaki frames all this through the lens of his two dads, right?
Yeah, his biological dad, the poor dad, highly educated government employee, but struggled financially. And then his friend's dad, the rich dad, an entrepreneur, maybe less formal education, but very financially savvy.
Two totally different philosophies on money, work, life, really. So let's start with that first big theme, financial education, or maybe the lack of it in schools.
Well, the book's central idea here is pretty provocative. It argues that our main financial programming comes from home. And for many, that defaults to what he calls a poor person's financial programming.
Think about the usual advice. Go to school, get good grades, find a safe, secure job. It's all about scholastic skills, professional skills, important stuff for sure.
Absolutely. But the financial skills, how to manage money, invest it, make it grow, largely missing from the school curriculum.
And that explains, like you said before, how really smart, successful people can still be, financially vulnerable. They're masters of their profession, but maybe novices with their own money.
It's true. And the book even scales this up, suggesting this widespread lack of financial know-how can impact things on a national level.
Yeah.
Financially illiterate leaders making decisions that lead to huge debts.
Yeah, that's a pretty sobering thought. The potential ripple effects on things like Social Security, national debt, it's quite profound when you think about it systemically.
It does make you think about the bigger picture, doesn't it? The long-term strain if people aren't equipped for self-sufficiency.
Okay, let's shift gears a bit. Let's talk about mindset. This is huge in the book. The difference between I can't afford it and how can I afford it?
Oh, absolutely. This is a cornerstone. The
Yeah.
poor dad often said, I can't afford it. But the rich dad, he forbade that phrase. He insisted on asking, how can I afford it?
It sounds like such a small change in words, but the impact on your brain is massive.
Totally. I can't afford it. Just shut your brain down. It's an endpoint. But how can I afford it? Forces you to think, to problem solve, to get creative.
It's like mental exercise. The rich dad saw the brain as a muscle, basically. Saying, I can't is letting it get lazy. Asking, how can I is like taking it to the gym.
Exactly. He believed you had to exercise your brain to find ways to make more money, not just to set limitations, mental exercise for wealth, just like physical exercise for health.
And it wasn't just that one phrase. There were other contrasts too, weren't there? Like talking about money at the dinner table.
Right. Poor dad thought it was rude or improper. Rich dad encouraged it. Or views on risk and foreign. Poor dad saw it as something to avoid at all costs.
Play it safe.
Yeah. Rich dad saw it as something to be understood and managed. Even fundamental things like, is your house an asset or a liability?
Or even the order you pay your bills in. It all points to these really deeply ingrained different ways of seeing the financial world.
It really makes you pause and question your own assumptions about money, the ones you might have picked up without even realizing it.
It really does. Okay, so the book isn't all theory. It's got these stories from his childhood, these early learning experiences, the toothpaste tubes.
Ah, yes, the failed toothpaste tube venture, trying to melt them down for the lead content, I think. It didn't work, obviously.
No. But the lesson was important, wasn't it? About doing something versus just talking about doing something.
Exactly. Even his poor dad, despite maybe not having the best financial advice, said something crucial then. You're only poor if you give up. The most important thing is that you did something. action matters.
Taking initiative, yeah. Then there was the job working for Mike's dad, the rich dad, for like 10 cents an hour.
Right. And initially, Robert and Mike felt exploited, angry. They wanted to quit. Totally understandable reaction.
I mean, who wouldn't? But Rich Dad turned it into a lesson, didn't he? He said something like, stop blaming me, you're the problem.
Yeah, if you realize that you're the problem, then you can change yourself, learn something, and grow wiser. It was about shifting focus inward, taking responsibility.
And the super low pay, that was on purpose too.
Absolutely. It wasn't about the 10 cents. It was a lesson designed to sting, to make them realize they didn't want to be stuck working for money their whole lives. They needed to learn to make money work for them.
Which led to them working for free for a bit and then spotting the opportunity with the discarded comic books.
Exactly. They saw those comics, realized others wanted to read them, and set up a little library in Mike's basement, charging admission.
And that was the real breakthrough, wasn't it? Their first taste of making money work for them, an asset generating income without them having to physically be there trading time for dimes.
That's the core idea they learned. Passive income. Breaking free from relying solely on an employer or trading hours for dollars. It's a fundamental shift.
Okay, this is probably the perfect segue into one of the most famous concepts from the book, assets versus liabilities. People talk about this all the time, but let's clarify.
It's surprisingly simple, actually, the way Rich Dad defined it. An asset puts money in your pocket, period. A liability takes money out of your pocket.
That's it, just based on cash flow.
Pretty much. Forget accounting jargon for a second. Does it generate income for you, or does it cost you money regularly? Think of an asset like a rental property bringing in rent. That's cash in.
And a liability, like a car payment or credit card debt.
Exactly. Money flowing out.
Yeah.
Rich Dad's point was the rich focus their energy on acquiring income-generating assets.
While the poor and middle class often acquire liabilities,
Yeah.
thinking they're assets.
Yes. And a classic example he uses is the primary residence, your home.
Right. Everyone thinks my house is my biggest asset. But Rich Dad argued.
He argued that if you're paying a mortgage, property taxes, insurance, maintenance, it's constantly taking money out of your pocket. So by his definition, it's a liability, not an asset, at least until it's paid off and maybe generating rent.
He had those simple diagrams, didn't he?
Yeah.
Arrows showing cash flow. For a liability, the arrow points out of your finances. For an asset, the arrow points in.
Yeah, visualizing that flow is key. Is it feeding you or are you feeding it? Understanding that difference is like step one to building actual wealth. You need to focus on buying things that pay you.
Okay, so understand assets versus liabilities. But then there's the whole idea of actually keeping the money you make. Financial literacy again.
Oh, absolutely critical. Kiyosaki hammers this home. It's not just how much you make, it's how much you keep.
We see this all the time, right? Lottery winners, pro athletes, huge windfalls, and then they're broke a few years later.
Exactly. High income doesn't mean anything if you don't know how to manage it. You need that financial literacy, that financial IQ to hold on to wealth and make it grow.
So it's about financial aptitude. Like, what do you do with the money once you have it?
Precisely. How do you manage it? Protect it. Make it last. Make it work for you. That's the real skill. It's being smart with the money after you earn it.
Which leads us to the rat race, that feeling of being stuck.
Yeah, the cycle.
Yeah.
Get up, go to work, pay bills, repeat. Never really getting ahead, just keeping your head above water.
And the book argues this is driven primarily by two emotions.
Fear and greed, or maybe fear and desire. Fear of not having enough money, fear of losing your job, fear of bills piling up.
And then desire, or greed, wanting nicer things, keeping up with the Joneses.
Right. And the trap is, even if you get a raise, often the desire just expands. You spend more, maybe take on more debt, and you're still stuck in the same loop, just maybe a slightly fancier version of it.
So more money doesn't actually solve the underlying problem.
Not usually, no. The rich, he argues, learn to understand and manage these emotions. They don't let fear dictate their choices, and they channel desire constructively, like desiring financial freedom more than a new car right now.
Rich Dad wanted to teach the boys to use fear and desire in their favor, not let those emotions control them. It's about emotional intelligence with money.
Yeah, making conscious choices based on financial principles, not just reacting emotionally to wanting something or fearing something. That's a key way to break out of the rat race.
Okay, let's tackle taxes and corporations. This part sometimes gets people talking.
It does. Kiyosaki has this somewhat controversial take on Robin Hood. Not a hero, but maybe a someone whose actions ultimately hurt the people he was trying to help by reinforcing dependence.
And he uses that to frame the idea that tax the rich policies often end up hitting the middle class hardest.
His argument is that the truly wealthy have ways, legal ways, to structure their affairs, primarily through corporations, to minimize their tax burden. So when taxes go up intended for the rich, it's often the middle class, who rely mostly on earned income, that feels the biggest pinch.
He talks about the history of income tax, how it started small, aimed at the wealthy, but inevitably expanded.
And how the rich adapted by using corporations. He stresses a corporation isn't necessarily a big building, it's a legal structure, a file folder in an attorney's office, basically.
A separate legal entity.
Right, and that entity has different rules, especially around taxes. Corporations can often pay expenses before taxes are calculated, whereas employees pay taxes first, then pay expenses. And corporate tax rates can be lower.
So Rich Dad's philosophy was, understand the rules, play the game smartly, and use legal tools like corporations effectively. It's not about evasion, it's about strategic structuring.
Exactly, playing the game by the rules that exist, but playing it intelligently.
This idea of playing smart leads to another intriguing concept. The rich invent money. What does that even mean? It sounds a bit out there.
Yeah, it's not about counterfeiting. It means using financial intelligence to create wealth opportunities, not just relying on a salary.
Okay, how?
Well, the book gives a simplified example. Imagine you find a great deal on something, maybe a small property or a business note. You use your knowledge and maybe some negotiation to structure a deal. Say you create a $40,000 note that pays you 10% interest.
So that's $4,000 a year in cash flow.
Right. You've essentially invented that $4,000 income stream using your financial knowledge and maybe some borrowed funds or creative structuring, rather than earning it directly through labor, where it would be taxed immediately as income. You created an asset.
So it's about creating assets that generate income rather than just working harder for a paycheck.
Precisely. And think about how long it might take the average person to save $40,000 after tax from their job versus creating an asset that throws off $4,000 a year relatively quickly through a smart deal. That's the power of financial intelligence creating opportunities.
Okay, so to do that, you need this financial intelligence. The book breaks it down into 4 main pillars.
Yeah, 4 technical skills he emphasizes. First, accounting, that's financial literacy, being able to read and understand numbers, financial statements.
Like reading the scoreboard of the game.
Exactly. Second, investing, the science of making money, understanding different investment strategies and vehicles.
Okay. Third.
Understanding markets, the law of supply and demand, knowing what drives prices, recognizing trends, spotting opportunities or risks based on market conditions.
Makes sense. And fourth.
The law. Specifically, understanding tax advantages, corporate law, regulations, knowing the rules of the game, like we talked about with corporations, to protect your assets and maximize returns legally.
And it's not just knowing one of these, right? It's the combination.
Yes, the synergy is key. Accounting helps you identify opportunities, investing tells you how to act, market knowledge tells you when and where, and legal knowledge helps you structure it optimally and protect yourself. They all work together.
Got it. Now, knowing all this is one thing, but actually doing it often requires, well, being bold, taking some risks.
Absolutely. The book makes a strong point that it's often the bold, not necessarily just the academically smart, who get ahead financially.
Yeah.
You have to overcome fear of losing money, fear of making mistakes, fear of what others think.
Self-doubt can be paralyzing.
Totally.
Oh.
But developing that financial IQ gives you more options, more confidence. It helps you analyze risks more clearly and make calculated decisions rather than just reacting out of fear. It helps you be adaptable in a world that's always changing.
And this isn't a one-and-done thing, is it, this learning process?
Not at all. Rich Dad stressed that the study of money is lifelong. You don't just graduate college and you're done learning about finance. The world changes, markets change, rules change.
Yeah, unlike maybe some other subjects, you can't just stop learning about money if you want to stay ahead, or even just stay afloat. Believing that just earning more money will fix everything without understanding cash flow, that's dangerous.
It's a continuous process of learning, applying, refining. Especially today, things move so fast.
Okay, another key phrase, mind your own business. What does that mean in this context? It's not necessarily quitting your job to start a company, right?
No, not necessarily. Your business, in the Rich Dad sense, is your asset column. It's about focusing your energy and spare resources on building and growing those assets that generate income for you, separate from your job.
So your job is your profession, but your business is managing and growing your assets.
Exactly. Don't just focus on getting a raise or promotion at work, though, that helps by providing capital. The real focus should be on taking that capital and putting it into assets.
Once a dollar goes into the asset column, it's like an employee.
That's the analogy, yeah.
Yeah.
That dollar should be working hard to make you more dollars. Keep reinvesting, keep building that passive income stream.
And luxuries, where do they fit in?
Luxuries come last. You build your assets until the income from those assets can pay for the luxuries. The rich buy luxuries with asset-generated cash flow. The poor and middle class often buy luxuries with their own sweat and blood, or worse, with debt.
That's a big mindset shift, too. Delaying gratification to build the machine first.
It is, which ties into another idea. Sophisticated investors look for something for nothing. ROI, return on investment.
How does that work? What are they asking?
They're asking, how fast do I get my initial money back? And maybe more importantly, after I get my money back, what else do I get for free?
Okay, explain that free part.
Well, take the example of buying a foreclosed property cheap. Maybe you quickly rent it out or refinance it to pull your initial investment back out. Now, you still own the property that's the something for nothing, the asset you got essentially for free, plus you might still have ongoing cash flow.
So it's about structuring deals cleverly to minimize your own capital left at risk and maximize the assets you control.
Exactly. Looking beyond just the purchase price to the whole life cycle of the investment and the potential returns.
To do deals like that, you probably need good advice. The book talks about paying brokers and advisors well.
Yes, this seems counterintuitive to some. Why pay high fees? But Rich Dad's view was that good professionals, brokers, accountants, attorneys aren't an expense. They're an investment.
They should make you more money than they cost you.
Or save you significant time or protect you from costly mistakes. If your broker finds you great deals or your accountant saves you a ton in taxes, they're worth paying well.
He contrasts this with how people might tip generously for, say, restaurant service and expense, but then try to nickel and dime the professionals who could actually help build their asset column.
It's about recognizing value. Are you paying for something that consumes wealth or something that potentially builds wealth? Good advisors should be in the wealth building category.
Interesting perspective. The book also touches on giving and teaching.
Yeah, the principle of reciprocity. Give what you want to receive. If you want more money, find ways to give value or be generous. If you want knowledge, teach.
Teach, and you shall receive. How does that work for learning?
When you have to explain something clearly to someone else, you force yourself to understand it on a much deeper level. You identify gaps in your own knowledge. Teaching solidifies learning.
Makes sense. Okay, building wealth isn't easy. Obstacles come up, fear of failure, laziness.
Huge ones. Fear of failure stops so many people before they even start. Rich Dad taught that failure is part of the process. Winners aren't afraid of failing. They learn from it. Texans say, if you're going to go broke, go big.
Haha, right. Failure's feedback and laziness.
Laziness often masks itself as being too busy. But often it's just a lack of strong enough motivation. Rich Dad suggested combating laziness by tapping into a little healthy greed, asking, what's in it for me? WIIFM. Find a compelling reason, a strong desire, and that can overcome laziness.
Find your why.
Exactly. A big enough why will provide the how.
The book wraps up with 10 steps to financial freedom, kind of summarizing everything. We don't need to list them all now, but they cover finding your reason, choosing friends wisely, mastering formulas, paying yourself first.
Paying brokers well, being an Indian giver with your investments, getting your money back quickly, using assets for luxuries, choosing heroes, teaching. It's a good checklist, pulling it all together.
And finally, it mentions 3 types of income briefly.
Yeah, just differentiating between earned income from a job, portfolio income from paper assets like stocks, bonds, and passive income from real estate, royalties, businesses you don't actively run.
And the goal is?
The goal for financial freedom is to convert that earned income into portfolio and especially passive income streams. That's how you eventually escape the rat race.
Wow. Okay. We covered a lot there. It really is a book packed with foundational ideas. If we had to boil down the absolute core takeaways from this deep dive,
I'd say, number 1, mindset is everything. Change I can't to how can I? Number 2, financial literacy is crucial. Know the difference between an asset and a liability and focus relentlessly on acquiring assets.
right. And number 3,
Make money work for you. Shift from trading time for money to building systems and assets that generate income passively. That's the fundamental goal.
Absolutely. Take control of your financial education. It's ongoing. So maybe the question for you listening is, which one of these ideas really hit home for you today?
Yeah, what's one small thing, just one simple step you can maybe take this week to start applying that idea?
Because that's what this is all about, right? Taking these insights and putting them into action. We hope this deep dive gave you some powerful tools and maybe sparked a few of those aha moments. The next step, well, that's up to you.